All right, let's jump right in. We're about to challenge one of the oldest, deepest human instincts we have. You know, an instinct that literally kept our species alive for thousands of years. But in today's world, it might be quietly wrecking your financial future.
Seriously, think about that. What if the very programming that helped our ancestors survive is now the biggest threat to building your wealth? It sounds kind of crazy, I know, but stick with me, because we need to unpack this.
I mean, for pretty much all of human history, survival was all about hoarding. You found food, you gathered tools, you claimed land, and you protected it with your life. Why? Because losing it all meant you were starting from scratch, from absolute zero. That instinct to gather everything up and guard it, well, it's hardwired into us.
So here's the twist. In the world of modern finance, that exact same survival instinct, it's become a trap, a really dangerous one.
That's not an exaggeration. That instinct to pile all your resources in one spot is a silent wealth killer. That feeling of safety you get from putting all your eggs in one super strong-looking basket, it's mostly an illusion. In fact, concentrating all your wealth like that can be way more destructive over the long haul than even a massive market crash.
So, why do we do it? Why does going all in feel so right, even when it can be so incredibly wrong? Well, that's what we call the all-in illusion. And let's be real, it's easy to see the appeal. Putting all your money into that one company you just know is going to be huge, it feels smart, it feels focused and decisive. It gives you this incredible sense of conviction. But this is where we get the idea of risk completely backward.
Okay, this is so important. Risk is not a feeling. It has nothing to do with how confident you are in your pick. Risk is a simple, cold, hard number. It's the number of different things that have to go perfectly right for your one big bet to pay off.
And just think about all those things. When you go all in on one stock, you're not just betting on their cool product. You're betting on their CEO not making a huge mistake, on their competitors not suddenly inventing something better, on government regulations not changing, on new technology not making them obsolete. You're even betting on them avoiding scandals and just having good old-fashioned luck and timing. That is a ton of things that have to line up just right.
You know what? To really make this crystal clear, let's step away from Wall Street for a second and look at an expert in long-term survival that we can all appreciate.
So, picture this. A squirrel works all autumn to gather up a huge stash of acorns. Smart, right? And to make it easy, it puts every single one of them in one single perfect little hollow in a tree. It's simple, it's efficient, but it has a catastrophic weakness. One bad event, a storm knocks the tree down, a fire, another hungry animal finds the stash, and that's it. Game over. The entire winter's food supply is gone in an instant.
And this is the absolute key to understanding this. The squirrel didn't necessarily make a wrong choice. The acorns were good. The tree seemed safe. The problem wasn't the decision itself. The problem was that the entire strategy was fragile. It had zero resilience.
Okay, so let's bring that lesson back from the forest and apply it directly to your money. This is all about changing your mindset, from making a single bet to building a robust system.
Think about it just like this. Concentration is a bet. It's a high-stakes gamble that you've picked the one true winner. Diversification, on the other hand, is a system. It isn't designed to pick the absolute winner. It's designed to make sure the whole thing survives and thrives no matter which individual parts fail.
And that difference? It's everything. A bet is basically a yes or no question. Are you right or are you wrong? A system, though, is built for endurance. And why is endurance so critical? Because it's the only thing that gives the magic of compound interest the time it needs to work. You simply can't compound your wealth from zero. Now, a lot of people get this part wrong. Diversification is not this pessimistic strategy where you expect everything to go bust. Not at all. It's just a realistic one. It's acknowledging the simple fact that, over time, something in your portfolio probably will fail. And that's okay, because the system is built to handle it, letting the winners more than make up for the loser.
This leads us to this really powerful concept, one that's often overlooked. It's not just about playing defense. It's about a special kind of offense we call the endurance advantage.
We all love the stories of the genius investor who makes one incredible, perfect call. It's like a firework, a spectacular flash that's amazing to watch, but it's over in a second. Real, lasting wealth isn't a firework. It's a marathon. It comes from endurance, from just staying in the game, year after year, letting time and compounding do the heavy lifting.
And here's the massive psychological benefit. When you're all in on one thing, a market downturn feels like a personal attack. It feels like danger. But when you're properly diversified, a downturn feels more like bad weather. Yeah, it's no fun, but you know it's temporary. You know the sun will come out again. You don't panic and sell your house just because there's a thunderstorm.
When you really get down to it, this whole idea is based on a core philosophy. It's not just a tactic you use. It's a whole mindset about how you approach an uncertain future.
This quote just says it all, doesn't it? Diversification is really just financial humility. It's you admitting, hey, I can't predict the future. You're not trying to guess the next winning company or country. Instead, you're betting on something far more certain, that over the long run, human ingenuity and progress will continue, somewhere.
And that right there is the bright line in the sand. Speculators are trying to predict the future. Investors are building a system that's designed to benefit from that future, no matter what it looks like.
Okay, so this brings up a really crucial final point, the illusion of diversification. See, it's really easy to think you're diversified when you're actually not. For example, owning 10 different tech stocks isn't real diversification. It's just 10 slightly different bets on the exact same corner of the economy. So how do you get it right?
True diversification means you own things that zig when other things zag. You want assets that behave differently under different conditions. You want some things that do great when the economy is roaring, and maybe some other things that hold their value when times get tough. You need different business models in different industries in different parts of the world. The goal isn't just to own a lot of stuff, it's to own a lot of different kinds of stuff that won't all fail for the same reason.
So let's wrap it up with this one final thought. That ancient survival instinct to hoard feels safe, but all it really does is build fragility into your financial life. Diversifying, on the other hand, might feel a little less exciting, but what it's really doing, day in and day out, is compounding resilience. And over the long term, wealth doesn't flow to the luckiest guesser. It flows to the most resilient strategy.